All right, thanks. Thank you guys for being a part of this discussion. Really appreciate it. I'm going to let each of these great investors introduce themselves. So just to kick it off, we'll just kind of start with you, Allyson, go down the line and just tell us, about you, your company, where you invest, check sizes, all that good stuff that everybody's going to want to know.
Okay, great. Well, thank you all for being here. Excited to see some familiar faces, meet some new ones. I'm Allyson. I'm a partner with Springtime Ventures. We do seed stage, which is sometimes a little moving target, but basically we do anything from pre-revenue up to probably around 500K in annual revenue across the US in health, fintech, and logistics and supply chain. All the three of us on the team all have had personal experiences as caregivers. I was thrown into a caregiver role for my mom really young, and I'm now in the process of going through that with my dad. And so it's something that's very personal to us. And so we tend to think of it within our healthcare vertical, but we're also interested in things that intersect with healthcare and like aging and fintech. We write checks of around 700K and leave some room to follow-ons and then subsequent rounds.
So I'm Tracy Chadwell. I'm the founding partner of 1843 Capital. We're an early stage technology venture capital fund focused exclusively on aging and longevity. And I came to this, I was a partner with $1 billion growth capital fund and decided to start my own firm in 2018 after I had invested in a company called Silver Nest, which some of you may have known, Wendy Burkhardt, who was doing a company roommate matching. So that incredible opportunity that I saw there, coupled with the fact that my mother had pancreatic cancer at the time and was dealing with caregivers, just really sparked the innovation in my head for this space. And it's been a passion project as well as extremely profitable. We do have 5 companies out of 13 in Fund 1 that are $1 billion companies at this point. But I will caveat that by saying we have to do it in a way that serves everyone, but then with a focus on older adults as well. It's not just things that are exclusively for older adults that seem to be making the $1 billion mark. So our check size is 500K and we focus on seed and Series A.
Great. Gimbel, I'm a partner here at Atlanta Ventures. We're actually up on the 5th floor here. So nice short commute to get down here. We have actually 2 investing models. One is we have a studio where we start our own businesses from scratch with entrepreneurs. So what's unique about us is we're all entrepreneurs and we're still entrepreneurs. And so we start a couple of businesses every year, going through the ideation and the customer discovery. So that's pre-revenue, pre-idea, just get going. We also have an early stage model where we invest in software, recurring revenue businesses, healthcare and other industries as well. And we typically write a couple $100,000 up to a couple $1 million checks in those. And then, Jeff and the passion, I love it. I got to see my mother care for 2 of my grandparents and the toll it took on her and the challenges she went through to that. So I have an extra special spot in my heart for the stuff that you're doing, Jeff. So thank you.
Great. Hey, everybody. My name is Sarah Slocum, and I'm with BIP Ventures just down Piedmont Road here. If you're not familiar with us, we're an early stage venture capital investor. We also have a little bit of a growth equity strategy too. We invest in anything that falls under B2B SaaS and tech-enabled services. I sit on our healthcare team, and healthcare makes up about 50% of our portfolio. So it's a fairly significant strategy for us. We are more opportunistic than thematic. So we have a decent amount of tech-enabled services. We do have pure play software. We have some companies that play more in the pharma space. So pretty wide ranging. We do have a few key portfolio companies in the AgeTech space. I would say Healthy Med and ChartSpan, maybe Phoenix Health, if you guys are familiar with any of those. So great to be here.
Hi, good afternoon. My name is Donna Sun, and I'm a partner with AgeTech Ventures. I'm flying in here from Chicago, so thanks for letting me soak up some vitamin D while I'm in town. AgeTech, the fund name, is a word that we made up, and it comes from combining the terms health equity plus age gives you AgeTech. So in case you couldn't guess, our entire focus is investing in healthy aging and senior care. So we're typically looking at seed and Series A stage technology and tech, software and tech-enabled services companies, typically writing anywhere between $500,000 up to $2 million for our first check-in. We can lead, co-lead, or be part of the syndicate as well. And because founders always like to ask what we can do beyond writing the check, I'm happy to share that we're super grateful to our LP base, which is made up of a lot of strategic operators and executives from all across the long-term care and aging spectrum. So everybody from executives at health systems, health plans, to coverage within post-acute, for example, within SNFs, senior living, home health, home care, hospice. We've got a lot of good penetration there. So our hope is to be able to bring their market insights and also hopefully brand new customer introductions and partnerships to founders as well. Thank you.
Cool. So Donna and Tracy, because we're going to split this a little bit, right? So you can see we've got some VCs here and investors here that have a focus and a thesis, highly evolved in the space, others intrigued. And so we're going to kind of split the next question up a little bit. So Donna and Tracy, can you talk about from where we are today, and this space has evolved so much since AgeTech even became a phrase that was in the normal lexicon, for advice, especially to aspiring entrepreneurs that have got that personal experience that are motivated to solve problems. Where are some opportunities that you're seeing that are evolving? Maybe these are waves that are breaking right now, and you can list a few if you want.
I think everybody always leans on AI and says, oh, we're doing AI for this or AI for that. We're building an agentic AI into our company. I'm staying away from a lot of those. And the reason is because there are so many companies in China that have both the dramatic AI capabilities plus reduced regulation plus population that they can take the data, and there's absolutely no regulation around the data. So I think we're really not going to be well positioned for that. If anyone is going to be well positioned for that, it's the existing incumbents that have all the patient data. So unless it's a company that is creating reams and reams of new data that existing health systems don't have, it's not as interesting to me. So I'm actually looking at things more tech-enabled services and consumer-focused health, because I really typically look at the payer. Who's paying? Is it Medicare that's paying? Is it a corporate benefits program that's paying? Or is it the consumer? And really, we're coming into this phase where the consumer is taking over, especially as healthcare costs go through the roof and people are having higher and higher copays and just have catastrophic care insurance now. I think that really the consumer-focused paying for all of these services is the place to be.
So a couple examples, but I'll just focus on one for now. I think throughout the day, you've heard a lot about the caregiver crisis actually as a public health crisis, so I'm not going to repeat that problem. So our thinking of it is really focus on the problem at hand and where we can really take a population health approach. Big problem, a lot of dollars, insufficient solutions there. So the way that we chose to tackle the caregiver crisis is, as we were speaking with a number of home care agencies, we noticed that one of the low-hanging fruit opportunities was very much around caregiver and client matching, and also making sure that coverage is correct, while also taking into account the caregiver's personal needs, right? And so that's actually a perfect opportunity for technology to come in. We're not tied to AI, kind of what Tracy was talking about, because from our perspective, it's just a modality of technology. Remember when VR was all the rage, or blockchain, right? They're just types of technologies, just like AI. It's a means to an end. So sometimes it's the right solution, sometimes it's not. But because we really wanted to do something to change the caregiver crisis, we invested in a very young seed stage company called Alden Health, ALDEN. Their focus is to be very intelligent in looking at different data from legacy systems, whether it's EHR, phone, based systems and beyond, to be able to not only quickly match the optimal caregiver with the right client, whether it's a Medicaid PCS or private pay client as well, but also ensure that there's real-time communications while taking account the caregiver's situation. One example is one of the agencies we're working with, one of their caregivers was recently divorced, and now they have part-time custody of their child. When that child stays with them, they have to be within a 20-minute driving distance of the child at all times for their travel, right? Well, guess what? Right now, EMRs suck at capturing information like that. In fact, they don't really care. But Alden's trying to make sure that all those personal elements, not just the client's needs, right, are also taken into account. So we're really excited and proud to be playing a small part in supporting Alden and trying to transform the caregiving journey and also helping others age at home.
Cool. Sarah and Allyson, talk a little bit about, where you're interested, where you find, see a lot of deals, what things catch your eye. You've sent me some deals over the years. You're like, what do you think of this? And then maybe talk about, you shared a little bit already, Sarah, but maybe talk a little bit about a company or two in your portfolio, dig a little deeper in, maybe on what they're doing, why it intrigues you. Maybe even share a little bit about how their journey's been since you made the investment.
Sure. Right. Yeah, sure. I'll kick things off. So maybe I'll start with just how we tend to look at healthcare businesses in general, but maybe more specifically in the the AgeTech healthcare side of things. I think there's kind of three big hurdles that we like to look at and kind of analyze how the companies are going about tackling them. The first being access, right? Are you going direct? Are you going through a payer? Are you going through a provider or health system? That hurdle can be pretty significant, and it can take 12 months. It can take 24 months just to get your customer, just to get in front of the inpatient. Secondly, and again, just as big of a hurdle is engagement. I mean, oftentimes in this population, you have patients with multiple comorbidities. You have patients that are unfamiliar or uncomfortable with technology. Maybe they don't have access. They're in a rural area and they, don't have access to other things that people in big cities might have. And so how are you getting in front of them, and how are you getting them comfortable with using the product or service? And finally, it is a little bit more of an afterthought in certain circumstances because it does take a decent amount of capital investment. But how are you collecting the data to prove that the product works, whether that's lowering the total cost of care or improving the quality of life, and in turn kind of expanding circular reference back to the access side of things. So that's generally how we think of the framework for our healthcare investments and AgeTech investments in particular. One of my favorite portfolio companies is called HealthyMed, and they serve the Medicaid waiver population in Minnesota. So if we have any Minnesota folks over here, perhaps you've heard of HealthyMed. But basically what they do is provide a tech-enabled service to the Medicaid waivered population through a television that they put in the patient's home. And through this television, they have two-way audio and visual, and they can connect that patient to whether it's family, a caregiver, a case manager, or most importantly, physician services, so behavioral health or primary care. And we're really excited about that. I think something that we've seen great expansion within Minnesota itself, but now we're looking bigger, and how do we take this and expand to other states and take advantage of kind of the existing infrastructure that they have there to roll out in a similar way. So maybe that's
good.
Yeah.
Yeah, so I would say for us, we are interested. We do in healthcare combination of just pure software plays and tech-enabled services. But we're really interested in intersections. So particularly, I'm interested in the aging and fintech intersection, and how do you plan, pay for your retirement, and also the associated healthcare costs that come with that. I am also interested, I think, having been on the caregiver side, anything that can help create a smoother journey around that. I mean, if you think about all of a sudden now you need access to your parents' medical records, their finances. And I mean, at least for me, things were always kind of kept in a black box, and then all of a sudden it wasn't. And so anything that can help reduce some of the friction of what it means to take on that caregiver role, I think are things that we're interested in. I think the other thing that I think a lot about, and we have an investment in the longevity space, actually, it's called Death Clock. And that is the hook. You go in, you answer 23 questions, I think, and then it gives you your death date. And that is meant to engage you and get you interested in taking some preventative actions. They're now just, I think within the last month, rolled out something actually pretty similar to Function Health, where you can go and you get your lab test, and then from there it gives you recommendations of what additional testing you might want to take so that you can understand your risk of certain, maybe it's cardiac, maybe it's metabolic, and then start working on the preventative side. So I think I like the idea of getting folks engaged earlier in prevention. And I also want to keep in mind that it's not just about extending life, but extending quality of life. And so it comes back to that last panel around how do you social interaction is so important, and how do you keep that engagement, which leads me to my other area of interest, which is not really a VC play, but I am fascinated by third spaces as you get older. I think that you're seeing with, there's, as religion has decreased among folks, I'm just super interested in what a third space, like kind of reinventing a third space for people as they age is really interesting.
Explain what a third space is.
Okay. So if you think about, you kind of have like your work home, what is this place where you can go, kind of like a coffee shop where you have community, that you can, and you have camaraderie, and it's a place that you can land and drop in, and it feels almost like a second home. I don't know. I'm using a lot of
cool.
numerals, but yeah.
I got it. AT. So by the way, I get to see firsthand what you guys work on. If I won the lottery today, and I would love to open a venture studio. I don't know much about it, but it seems a fascinating way to approach innovation. Can you explain to our audience, not all studios are alike. So, what Atlanta Ventures is from the studio perspective, and how do you go in your studio from idea to launch?
Yeah. So first off, this is my favorite part of my job, is in the studio trying to start new businesses from scratch. And so simply what our studio is we co-found businesses from scratch with great entrepreneurs. And so the way that process works is we're always out talking to people, problems, what are they working on, trying to see what's going on in the world, and asking ourselves a lot of questions, right? One question we ask is, what's something that's going to be commonplace 10 years from now, but hasn't happened today, and why? Is it consumer sentiment? Is it regulatory? Is it technology? But it's likely to happen. It's just a function of when. And what we often find is 10 years is actually more like 5, 6, 7 years. And if you start now, it's going to take a couple of years to figure some things out anyway, but then you're trying to catch that market tailwind. And so we're big believers in finding and making educated guesses on what are some of those market tailwinds. They're going to precipitate these things happening, and how can we figure something out in that space? So how do we do that? We start with that theme at the top, right? Hey, there's themes we're looking at around longevity, around robotics, around very high level themes, right? Well, then within that, all right, what are some problems in that space, right? So there's some problems here, doing more customer discovery, out talking to people, right? Understanding, what do you do? Why? Tell me more, right? There's a great book that I love called The Mom Test. My favorite books we have entrepreneurs read. And first time I read it, I realized all the mistakes I'd made in the past trying to start things. Because you go to people and say, I've got this great idea. What do you think? And mom says it's great. And your friends say it's great. You think you got a great idea. And then they tell you, yes, I'll use it. Yes, I'll pay for it. Yes, I'll buy it. Go build it and come back, and then I'll buy it. And I'll go back and I'll spend time and money building something. I'll say, here it is. And then nobody buys it. I'm like, why? Well, that's the mom test, right? It's like you have to ask people not about what they think about your idea, but what are they already doing? Why? Did you already look for software to buy that? Why or why not? What worked with it? What didn't work with it? And so a lot of questions to keep digging in on the problems and finding a problem that's must have versus nice to have. There's a lot of things that are annoyances that would be cool to have, but cool doesn't build a great business. Having something that's mission critical to what they're trying to do. And so we spend a lot of time iterating through that, the themes, the problems, and then eventually down to specific ideas. And as part of that, we do that with entrepreneurs so that they're part of that discovery process with us, so that they're hearing and understanding what we're hearing and why, so we can adapt. And there's many iterations and pivots through that. And then at the end of the day, once we've gone through some of that and a bunch of the iterating, we don't launch a studio company until we've found authentic demand. And we define that as people will pay for a product that does not exist yet. We intentionally do not build anything in the studio out of the gates, because I'm a firm believer, if it's really mission critical, if it's serious, through all those conversations, they will be leaning in and want anything to do with what you're trying to build, and they will pay to build a first version with you. If they say, come back and build it and then I'll buy it, that's not for us. And so we really like to test that willingness to pay early on, because I've just been burned so many times, and I see others burned so many times. If you spend a lot of time and money building some very great tech that makes perfect sense why they should use it, and they don't. And so we really push hard to test that in the beginning.
And are you guys operating in both the B2C and B2B spaces, or?
Yeah, so in the studio, we're pretty broad. Our early stage, we stay more B2B. We've done some B2C, like there's a company called Reframe. It's a direct-to-consumer healthcare app out of Atlanta, building healthier drinking habits. We invested in that one here. But some of our studio ones are B2B, and then we also have, like, I love the community idea. We've started 2 different community third space ones, one called In Town Golf Club. It's an indoor golf and social club here, now in 6 cities. And then we just opened early this year, the Perlant, which is a wine-focused social club here. So we love that whole community theme.
Cool. I mentioned, or the last question I prepped you guys on, I'm going to reframe it a little bit. I think you'll like the way I reframe it, so it's not like ambushing you on this. Advice, we have a lot of early stage folks in here, founders, and we have other folks who are kind of earlier than early, right? What advice would you give to these entrepreneurs, many of whom are charging into this space led by a personal story? But what are some of the fundamentals, some of the best practices and approaches that you would recommend to these founders? I initially phrased it so that they could position themselves for investment, but to have sufficient capital, whether that's angel investment, VC investment, other ideas. So what's some advice to these startup founders? And I ask this is a passion question, because I have the joy of answering many midnight phone calls from people who are stuck between that family and friends or pre-seed, and there's no hope to get to right now to get to that next round. So they're out of money. So what are some words of advice? Make it as granular as you would care to get, and feel free to talk about some real world examples.
I'll start. So I would say first point is recognize that venture capital is not for every business. And so really understand that when you take money, you get on a treadmill. One of my partners calls it the VC treadmill, and it only gets faster and steeper the more you grow. And so really understand what it means to take on VC, and understand if you are the right type of business for that. I think the other thing that I would say, we invest early. Like I said, we've gone pre-revenue. I think the thing that you really, at that stage, there's so much risk. And the thing that we can underwrite is the team. And so being really crystal clear on why you and why now. And I mean, we all want to have an impact and have a positive impact, but at the end of the day, all that our LPs care about is how much money we return them. And so be able to paint that big picture of how are you going to really drive the returns and grow quick enough and big enough so that I can make my investors happy and keep investing.
So my greatest advice is don't take outside money. Don't raise money. Bootstrap, build a profitable business. That's historically how all of this has happened. And now all of a sudden we have 8,000 venture capital funds out there funding soda pop. This is a business that was built originally on funding technology companies that had an urgent need with a constrained resource with a high margin and ability to scale. And we're not seeing that anymore. And guess what? Nobody's exiting. We now have probably, I don't know the exact number, but it's some $1 trillion worth of companies that are sitting waiting to get an exit in this space. So we're going to have a lot of venture capital funds going out of business. If you take my money, I want at least 30% return annually. You put money on a credit card for less. You can get money from a bank for less. But you know what's even better is getting non-dilutive capital as a grant, right? And just because a business isn't necessarily sort of a stupid venture capital business doesn't mean it's not a great business, a viable business, interesting, and shouldn't exist in the world. It's just maybe not that little sliver that qualifies for venture capital funding. So I think you have to get creative about your funding sources. And the best way to get creative is revenue.
Yeah, I mean, I'll echo that, and I'll elaborate on that, right? We're big fans of bootstrapping to the start. Like when you go to raise money, a lot of people try and raise money to figure something out. That's not the best time to raise money. Raising money when you're already proven something you need to do, go from 5 to 50, from 50 to 500. That's where raising money is helpful. And so 3 practical tips to what Tracy was just saying, right, is number 1, you have a day job, right? And you're working nights and weekends. It's going to take longer, right? But you can still fund yourself while you're figuring all these things out, right? Second area is go sell consulting services or projects, right? It's not the ultimate goal of what you're going to do, but it gets money in the door. And more importantly, it gets you closer to customers and their problems so you can learn and iterate. And then thirdly, get customers to pay, as we talked about, right? The best way to get investors is to have paying customers. And so not only does it help you get money in the door and learn, it'll help you with investors down the road.
I would say my advice is to be strategic about the amount of capital you want to raise. And when I think about it, I think about kind of milestone-based funding and being intentional about which point A, how are you going to go from point A to point B? And is point B when you want to do your seed and point C when you want to do your Series A? Okay, then work backwards. How much time do you need to get to each of those points? How much money do you think you need to get there? It doesn't have to be exact. And again, I know for startups, sometimes point B and point C might be a little fuzzy, but directionally, and if there are kind of broad-based milestones for the specific niche of the industry that you're in, or given kind of the customer base that you're selling to, I think in healthcare, that's really, really important to pay attention to. And especially if you're not just selling a software product, if it is a tech-enabled service that might be a little bit more capital intensive over the long haul, there's nothing wrong with that. But being mindful of how much capital you've raised to get to each milestone will help you as you begin to position for the next time you're going to market.
I'll be a bit more tactical. If any of you have ever gone into a VC website, do they kind of sound similar to like we're founder friendly, early stage, blah, blah. And, we're guilty of that too, just because there's a lot of marketing slop, right? So one of the questions I get asked from entrepreneurs a lot is, so how do I curate my list? And how do I know this investor is actually going to be good for me and vice versa? What I say is, okay, just don't even read the marketing stuff on their website. It all sounds the same anyways. Talk to the portfolio companies they've actually backed. Plus, founder to founder, they'll be very honest with you and they'll give you the feedback on what we're good at, areas we need to be improving in as partners to them as well. So they've got the real tea for you, if you will. And by looking at the companies that said investors have backed, that'll also tell you what the kind of optimal stage and a real check size is. So look at where the money's actually flowed into, not just the stuff that sounds very generic on the website.
We're going to redline out one attribute. I want to ask you what you look for in a founder. Just because a quick riff. You cannot say grit. Everybody says grit. We all have to have grit now, all right? Babies have to have grit. So other than grit, what do you look for? Or a couple things.
I recently read, I think it was the Slow Ventures team that put out an analysis on the type of attributes that they like to see in teams. And one of the things that they highlight is hyperfluency. And it actually gets at this really unique ability. I think about all of the founders that we've backed that have gone on to do really spectacular things. And they have this ability to talk at a super high level, but also go super deep. And you can see that they were made to solve this problem and there is nothing else that they will go do. And it's that kind of level of almost obsession that kind of comes back to grit, and like they're going to have the tenacity to weather those early stages where it's a lot of highs and lows.
We've seen the greatest success in a second-time founder that's failed. So a founder that had a company that didn't sell for very much, they have a huge chip on their shoulder and they're going to win this time, but they have lessons learned.
Those are two of the ones that are on our list there as well. And another one that I'll add that's on our list is we call it a sales orientation. And what I mean by that is you don't have to be a salesperson, but there are many founders who are scared of sales. They think they can just go build a great tech product and bring in a VP of sales and the product will fly off the shelf, and it just doesn't work that way. And so we look for founders who are comfortable being out, talking to customers, learning, making those first sales. And you learn so much in those first sales about what works, what doesn't work, the messaging. And then you can translate that to your team to go build up when you outsource that, you lose all that learning and information. So we're big fans of that sales orientation.
Yeah, there's a lot of words floating around in my mind right now. I would say probably thoughtfulness. And what I mean by that is thoughtfulness when entering a meeting with investors or customers or even employees or fellow executive team members, being aware of the surroundings and being mindful of, okay, what needs to get done here? Who am I speaking to, and what's the best way to communicate my message? I think seeing that in a leader, we've had great success in those types of leaders.
For those who are first-time founders, fear not. I've had good exits from first-time founders. I've also had ones from serial entrepreneurs as well. When I think about some of the common traits, though, from the team compositions, it's something that I like to call healthy tension, right? So I like to try to pressure test for that throughout different points of conversation. For instance, if you're an early stage, seed stage company, you're probably not all aligned entirely on the product strategy and the business strategy. There's just so much room for evolution, right? I'm going to say the opposite. I want to see how you think. Can you listen to that? Can you assess on your own? What if your teammate thinks differently? I think that the best teams know when to push and when to pull away, and they don't get upset, right? They don't see it as an insult. They just see it as a richer conversation. So I need to see a healthy, like authentic, healthy tension in the team. Otherwise, we won't get there.
Do we have time for a question or two? Oh, lovely, lovely. Good. You guys want to ask some questions? There's always questions for VCs. Nicole. Nicole is not the furthest prize, but close. So I got to give you a first question. We're coming all the way from Pennsylvania. That's a pretty good trip, right?
Oh, yeah.
Right.
Hi, my name is Nicole Jones. I'm president and founder of Little Red Riding Hood, Inc. We are a senior transportation company, network transportation company that focuses in rural areas. So my main thing is when I've brought this up to other people, the one thing I hear is, ooh, rural area. But they don't understand how important it is and how, especially with seniors, I mean, there's over 30% population in many of these areas. What do you guys think of the moment you hear rural area?
It's fine for me because I have two companies that are two of my most successful. One is a care driver company where it's a care driver in the car picking up people. But then also I have a company that is doing autonomous driving. And when I hear something like that and I hear a real need, I hear government. I hear grants. I hear this is where your customer is. They're the ones that are going to support people that are that far away. And with the autonomous driving company, we've had multi-million-dollar contracts with cities to drive older adults that are free to the older adults to give them as much transportation as they need. But then it also just won a $900 million contract from Uber. So it's a phenomenally successful, but also can support things like that. So it doesn't scare me, but I think you just need to find the right person to pay. It always comes back to that.
And I would say to that too, just in general, when you're talking to potential investors or anybody, if they don't get the space you're going after, don't waste your time talking to them, right? Because either they already are passionate about it and are willing to learn more and be with you, or they're already experts in the space and have companies. They're going to be your better investors than otherwise you're going to spend a bunch of meetings trying to convince them about what it is, and they're going to say no at the end. You're going to waste your time.
I agree. Only educate an investor if they're a friend of yours.
That's my quote from the panel. That's good.
Nice.
Donna, do you have a comment on that? Looked like you did.
Oh, I was going to say there's actually I've seen a lot less competition in terms of people trying to build for rural senior care, which is not good for the patients, but it's actually a kind of a nice side effect for the builders there. So there's just a lot more white space. We're deep in diligence looking at, I won't say too much, but it is a care delivery company for seniors living in these, like, they call them tier 2, tier 3 geographies, or we can call them rural areas as well. And that's one of the beautiful parts, is that there's very little other options. So the market is theirs to take, assuming that they're actually, meeting those quality standards.
I mean, to the extent that I'm on the phone with executives that are in healthcare, payers and providers, I always just ask, well, what are a couple of big unsolved problems? Rural or tier 3 markets, access to care always comes up. So it's a big problem. Let's go in the back right there. Holler at me if you run out of time.
Thank you so much. Hello, everyone. I have a question, actually two questions for all of you. So I am co-founder of Foresight Cares. We're based in Charlotte. We actually received more than $2.5 million of grant and non-dilutive funding to just build a technology. But at the
That's
end
awesome.
of the day, the federal grant not going to pay for your marketing and sales. So we need capital money. But still, we don't have revenue, and still I hear revenue as evidence. Honestly, if we had revenue, why we need investors? And where is the risk you guys are taking? So it's feel weird a little bit. I feel that there should be more, pre-revenue seed funding, especially for sales and marketing, because it's not just technology. So
We're not providing a service, we're running a business. And that's the difference. So providing a service, if you needed some, I always say, don't tell investors what you need, lead with greed. It's all about the greed, how much money they can make. It's not about you needing something or you deserving something. It's we're in a business, so we're only looking for places that can be profitable quickly and can scale well. So, and showing revenue is evidence of that. But that revenue may not cover all of your expenses. We're okay with that as long as we can see a path to rapidly increasing revenue, and then we're willing to invest. But maybe that's not enough to sustain you in the long term.
sure. And the second question, I know we don't have that much time. So 97% of older adults, they're not living in independent or assisted living communities. And they're living in their own homes, mostly low income, rurals. Why most of the VCs are interested in B2B, not B2C? Why B2C is a bad word with VCs and they don't like to see it?
I actually love direct to consumer, but B2B is perceived to be able to scale easier.
Let's just put it this way. D2C in a prior fund's experience, very, very hard to sustain that engine. I'm not sure if your business is meant to be B2C or B2B, but our customer acquisition cost was very, very hard to reduce. And we learned and that company did go out of business. So we've put our money in that previously, again, not at this fund, but at 2 funds ago. So we've learned the hard way. So that's why I generally stay away from that.
I can opine really quickly. Certain populations are covered by Medicaid, for example, and the example of Healthy Med. And so we really don't have much of an option other than to go through a large payer to have access to that population. And so that is a good example. And in certain cases, it can be just as challenging as D2C, where you do have to go through a case manager. So it is a little bit like one at a time. But at the same time, you can't, it is challenging to go to certain populations direct to consumer. So it's another reason.
One more question, and we're going to go with, sorry, dude. I got one more panel to go, man. You can ask a question there. Let's wrap up with a question from a reporter. Meet Jane M. with AgeTech Journal. Ask away.
Sorry. There's a lot of international founders trying to break into the US market. What would be your initial concerns with people who are trying to break into the US market from another country, and what would be your advice to them?
I mean, I can start. So we only invest in US-based companies and US-based founders. And I think we work in fairly regulated industries. And I think the biggest concern is that the healthcare system in the US is so complex. Like I try to talk to my husband about like a third party administrator and his eyes just like start to glaze over. And so like, and so it's just, if like, it's hard for even if you grow up here and like have even like you're enough to be dangerous. And so I think that's one of the big concerns we have, whether it be in healthcare or fintech, that it's just so regulated and there's so much complexity that we like to see domain experts. And so, I mean, it's hard for us to back a founder if they did grow up here, but they have no prior healthcare experience. So I think that's usually, at least for us, the big concern is just the knowledge gap.
Yeah, similarly, the other thing I would say is a lot of healthcare is relationship building as well, and knowing the local ecosystem or the different constituents, whether they're payers or patients or providers. And so having familiarity with that, I think, would be a question I would have for somebody coming in.
Just because you've sold into one healthcare enterprise, like one health system, doesn't mean you know all health systems, right? And I think that's the tough part of building a repeatable sales playbook in the healthcare space. And so kind of to what was mentioned earlier, when the team is ex-US, right? How do they have the relationship depth, but do they understand the nuance between, let's say, regional versus these national kind of accounts, or accounts in different lines of businesses on the payer side, those that are more commercially heavy versus Medicare versus not, right? So all of those are kind of tricky. There's just no shortcut for experience. So this is why when I see ex-US companies come to the US, one of their biggest goals is try to find the right chief commercial officer. But the caveat there is there's no silver bullet for this, right? So yes, you can try to build out that US sales team. At the same time, the ex-US team needs to actually spend a lot of time in the US ad market. You need that face time to build that trust.
Final word?
I was just going to say, and you touched on it at the very end there, but time in market is really important because of the sales cycles, for better or for worse, that we have to deal with the U.S. healthcare system. I mean, whether you're selling into a health system or a payer, or whether it's regional or national, I mean, it can be 12 to 24 plus months, and there's nothing you can really do about that. It's just, unfortunately, the way the world works. So time in market would be my biggest concern there.
We backed one company that was located in Vancouver, Canada, because they had very unique technology which hadn't been replicated in the United States. So that's the only use case where I can see investing outside.
All right, folks. Thank you all. We appreciate you and all for sharing your insights.